Okay, so I'm seeing some more people join right now, right at the top of the hour, so we can get started. My name is Luke Bader. I am Director of Membership and Programs at the FAIR Institute, and I want to thank everybody for joining us on this webinar today. This webinar today is part of our sponsored series webinars that we bring to the FAIR Institute community from our partners and sponsors in the space. And today's presenter is a team from Protiviti, and they're going to talk to you about using FAIR to understand change in resilience risk. A few notes before we get started. This session is being recorded, and the recording and a copy of the slide deck will be available on FAIR Institute link following the call under the FAIR Institute presentations and FAIR videos section on the resource library. Throughout the presentation, if you have questions and would like to ask the Protiviti team, you can use the GoToWebinar module to type out your question and put it into that Q&A section, and we will save all the questions for the end. For as much time as we have at the end, we'll get through as many questions as possible today within the hour. One more note too is that our big annual conference, FairCon, is coming up very soon at the beginning of October on the 6th and 7th. And to hear more from Protiviti and from a number of other great speakers in the space, both practitioners and thought leaders, please sign up and register to attend the conference. It is virtual, hosted on, like I said, October 6th and 7th. But then afterwards, all those sessions will be recorded as well if you're not able to make it during the exact date. So if you're a FAIR Institute member, registration is free. If you're not a member and want to become a member, that's also free. Check out our website pages to register and to learn more about membership and also FairCon tickets too. So with that, I am going to turn it over now to Vince Dasta at Protiviti to introduce himself and the rest of the team and then get right into it. Vince?
Hey, Luke, thanks for the introduction. Great, I appreciate the opportunity to present today. We're excited about the topic and we'll be going through hopefully some very useful information and some details that you all can take back to your own companies as you work through these types of analyses and understand kind of this unique use case of FAIR. I'll start a little bit with some just introductions of who we have presenting today. As I mentioned, my name is Vince Dasta. I'm a director at Protiviti within our technology consulting practice. I specifically lead our cyber risk quantification team, which is a team within Protiviti that is dedicated full-time to helping companies conduct quantitative risk analysis and operationalize FAIR within their own organizations. I've been connected to the FAIR Institute now for a number of years. I'm the chair of the Chicago chapter of the FAIR Institute, as well as looking forward to presenting at FairCon this year. I'll let my other panelists introduce themselves, starting with Doug.
Thanks, Vince. Doug Wilbert. I'm a managing director at Protiviti in our risk and compliance practice. I also lead our capital markets and our operational resilience efforts, so I appreciate the FAIR Institute for letting us speak today, and thank you everyone for joining. Bill?
Yes, thanks, Doug. Bill Forcell, I'm Associate Director in the Risk and Compliance practice at Protiviti. I recently joined Protiviti, and previously I was in bank regulation at the OCC for approximately 10 years, including capital adequacy and stress testing, DFAST type work at the OCC. Previous to OCC, I was in the financial services industry under various financial management positions. So thank you.
Great. So what we're going to do is talk about essentially three different topics to tell the story of how to use FAIR to help measure and quantify the change in resilience risk. We're going to start with a little bit of a background and some introduction about operational resilience as a concept. We'll talk about why it's important now and what the attention is, a little bit of background on how we got to where we are. Then we'll talk about how to use FAIR in the domain of operational resilience by going through an example of an analysis where we'll actually look at a hypothetical situation at a large national bank and show how to conduct the analysis, how to interpret the results, and what that means. And then finally, we'll follow that up with what's the real tangible benefit of doing this with an example of from the capital requirements perspective and a way to make this really tangible for your own company or for your own financial institution to actually get a real return on investment from doing this type of work. So I'm going to start by handing it over to Doug to talk a little bit about operational resilience generally, and then we'll go from there.
Thanks, Vince. So the genesis of the conversation today actually came from Vince and I sitting down and talking about operational resilience and how FAIR can be used to quantify the resilience of the organization. So if you can go to the next page, Vince. So I'm going to go over what resilience is and then dig a little deeper into, or let Vince dig a little deeper into with some examples on it, and Bill sort of tie it up to how we can use FAIR for things other than cyber security quantification. So background on resilience, given the audience, I'm sure everyone's aware of some of the cyber attacks that have gone on, which correlates directly to FAIR. Resilience also correlates directly there. And if you look at the June 2018, the Visa outage, which was not a cyber attack, but just an outage in Europe where people could no longer use their credit cards to pay for goods and services, was sort of the straw that broke the camel's back. And the Bank of England came out with papers in 2018 and 5 more discussion papers in 2019, pushing the topic of operational resilience. Very simply put, it's the ability of an organization to continue to deliver goods and services in a stressful environment. The stress could be caused by a power outage, a cybersecurity attack, or any host of other things, a data center going down. The idea is that A, the system is stressed, and B, it's an important service where people still need to use it regardless of the stress of the organization that's delivering it. For example, if I want to pull out cash from my ATM and I can't, it's a problem. If I want to use my credit cards and I can't, it's a problem. So going down to the bottom here, where it says, why is it important? Resilience is becoming more important because the landscape of risk is changing. We can look at environmental risk, we can look at cyber attacks, whatever sort of event you want to look at that can cause challenges within an organization. The bell curve seems to be expanding, and what's extreme and plausible today, years later seems more BAU. The impacts of the stability of the financial system, as well as the viability of firms, are important. If you go back to 2008, when everybody was scared of financial firms going under, the BOE brought the same concept alive, which is if there's a bad enough operational event, it could actually cause a firm to go under because they just can't make money. Sort of, I think the most stressful one that I've heard of late is a ransomware attack where there is no ransom. In other words, I just want to cause disruption and you can't pay me to get back your systems. And I think we've all seen the Garment attack recently as evidence that these are real. If we go over who does it impact, and I apologize for moving a little quickly here, but I think that the meat is more important than the background. It impacts large firms whose activity threatens the financial stability. If you look at the US side and their view on resilience, they approach it from a systemic fashion. If you go over to Europe and the UK, they approach it from the concept of harm, which is, does the downtime of the organization cause harm to the consumer? Smaller firms where activity is big enough to threaten a firm's safety and soundness, this is taken over from the UK perspective. And finally, third-party providers of important business services and sector-level services. Third-party providers is sort of the unknown, and third-party providers is quite broad. I can look at the cloud as a third-party provider. I can look at my SaaS software provider as a third-party provider. The challenge as well is that third-party providers beget fourth and fifth-party providers. For example, if I'm using software as a service and we both have the same cloud provider, my fourth party is very important to me. So the background sort of fits the need. All major regulators are focusing on this, and when I say all major, Basel came out with a recent article on it, or a recent discussion paper on it. The BOE, the PRA, the FCA, ESMA, the FRB is anticipated to come out with a discussion paper on it, and the OCC has made it one of their priorities for 2020. So it's alive, it's here to stay, and it's something that we all have to focus on. if you can move forward one, Vince. So where does resilience sit? You'll see in the orange on the right, I give the definition again, or we give the definition again, the ability of an organization to withstand adverse changes in its operating environment. If we go back classically to RPOs and RTOs, regulators were contemplating how much data can I lose and how long can a system be down. And it was a system level focused or an application level focus. Where resilience is moving to is a service level focus of the same idea. So for example, if I am providing payment services and a payment application goes down, resilience doesn't contemplate the RTO or the RPO of the payments system that went down. It's saying how long until you can bring that service back up. What it's doing is it's adding all of the dependencies, the people, processes, and procedures required to bring the service back up. So you can think of it almost as the RTO at a service level. What resilience is also looking at is once you devise that RTO at the service level, the BOE in particular wants you to go back and say, if you can recover this service in 3 days under a cyber attack, I want you to compare that to how long the business can be down and still be a viable entity. Let's say I have a cyber attack and I'm down for 3 days, but if I don't provide goods and services for 2, I'm out of business. The regulators want to come back and say, look, you've got to enhance your recovery efforts, because if you're down for 3 days, you're out of business and we can't have that. So there's a feedback loop that the regulators are going to use to make sure that businesses support their internal systems and most importantly can support recovery. If we can go to the next slide, Vince. So I'll leave a lot of the FAIR jargon to Vince, but what resilience is looking at is the loss magnitude. The risk or the risk component of it, some regulators are starting to look at and include. The BOE, which was the sort of organization or the regulator to bring this to life, what their suggestion was is to crystallize that things will happen. You will have an event, things will break. What you want to do is look at your primary losses, your secondary losses, and see what does that entail, and create an impact tolerance that's really a graph of downtime versus cost. And when you decompose the cost, and this is one of the reasons why we used FAIR, there's a lot of things to look at. You can look at the primary losses, which is customers, revenue, productivity, and then you can look at the secondary losses, which can be quite broad: competitive advantage, reputation, regulatory. How do we quantify regulatory? It's very hard, but we need to include that because, in fact, if we do go down, regulators will be involved. Okay, Vincent, we can move forward.
Yep. Good. And, and I think one thing to add to that, and I think is very important is when we've looked at adapting the FAIR model to this particular question or this particular problem space, it was very clear early on that the focus was on the right side of the FAIR model, the loss magnitude component of that. So when we talk about the analysis that we go through, and we'll demonstrate how we did this, we essentially are only looking at a single loss event magnitude. And, I think that's a very unique point of view. And I think when we work with most of our clients that use FAIR today or that are adopting FAIR, some of the key metrics that come out of a FAIR analysis, things like annualized loss exposure and loss event frequency and these types of things, are really less important when we talk about resilience. To that point, it's about understanding the capacity for loss and understanding, as a factor of time, what an operational outage or an operational impact would look like. And again, going back to the decomposition here, we look at this from a couple of different perspectives, which I think is also a unique viewpoint with a FAIR analysis. Traditionally, when we do a FAIR risk analysis, we look at this from the viewpoint of our own organization. What are our losses going to be? But when we look at this more systemically, and when we start to factor in these other things that matter from a resilience perspective, we have to look at this from a couple of different perspectives. And we've broken this down again by the firm, by the losses to the customer and their impact, the financial sector, and the general public as a whole. And so being able to decompose this is very useful. Because it allows us to understand the different dynamics of this. And I think one of the shortcomings that companies have tried to kind of use, let's call it out of the box fair analyses to answer these questions, is that you miss some of these viewpoints, which are very important to the regulators, as we mentioned around the Bank of England, is very focused on kind of harm to the public or harm to your customers. Whereas on the US side, we're typically more looking at systemically to the sector or direct losses to the firm. But a fair analysis allows us to take these different viewpoints and to understand when one of these resilience events occurs, what are these outcomes from these different perspectives, and do this in a way that's repeatable and consistent, and also transparent, which is very important. So what I'd like to do now is walk through an example analysis that we put together to help actually quantify the change in resilience risk. And we did this using a comparative analysis process. And at a very high level, the way that this works is that we conduct a baseline analysis to help us understand what loss exposure or what single loss event magnitude looks like for this particular event that we're modeling based on the same type of scope that we normally use with a fair analysis. But then because we're looking at a change, we then go back to that model and our assumptions, and we determine and document what will change when we look at a particular initiative or a particular project that we're doing to increase resilience. And using a structure and a model like FAIR allows us to do this, again, consistently, which I think is very important, so that we're using the same forms of loss, the same factors, and the same basic models to determine those changes. Once we do that, we can go back to our data or back to even our calibrated estimates and some of these extreme but plausible events that haven't occurred in the past. And we can adjust those estimates, we can adjust those inputs to the model, and then rerun that analysis. And what this gives us is two analyses conducted in the same fashion, using the same model, so using the same units, so that we can then compare these two to each other. And we'll walk through an example of what that looks like and some of the conclusions that you can draw by comparing fair analyses like this. And as with any fair analysis, it's important to properly scope the loss event scenario. So for the example that we're going to use today, we're going to look at a variety of different threats and methods that all have the same impact to a large national bank. And we're concerned with a loss of availability of what we're calling the consumer banking services. Interesting things to think about here is, that you can take back to your own fair analyses, is that we're looking at an asset in this case as a service. As Doug talked about in the beginning, resiliency is about the service itself, not necessarily the underlying technology components of that or the individual applications or servers that support that, but the ability to deliver the service as a firm. So when we look at the consumer banking services, we were able to group and aggregate together in a single analysis 3 different threats with 3 different methods that it would all have a similar impact on the availability of the banking services at this hypothetical bank. And this hypothetical bank that we've used, just for some points of comparison, it's a national bank with annual revenues of $86 billion and about $1.8 trillion in total assets. This is a relatively standard bank that provides retail and commercial services, as well as wealth management, financing, treasury management, and about 14 to 30%, depending on kind of the way that we look at this, of that bank's revenues earned through consumer banking. Okay. So the first step is to, again, look at the right side of the FAIR model. We're specifically looking at loss magnitude in this case. So what we did is we made some assumptions and we did some research on similar outages and similar events that have occurred at comparable banks. The benefit of doing this type of analysis is that all of that information is generally public. The reality is that very few large national banks have had an interruption of their banking services that hasn't been public. And we could argue that if it hasn't, it wasn't truly impacted. And what we found is a distribution of these typically last anywhere from 1 hour up to a day, most likely based on the historical data that we were able to reference. We saw a duration of outage of just over 4 hours. The other piece of this, when we talk about the FAIR forms of loss, is we wanted to understand the productivity loss in this case of both lost wages and lost revenue during that time. And so to do this, we took a reference class of a similar bank to understand the employee impact, and both from a back office, a front office, and a branch perspective. And we determined that there's a lot of variability between these different banks and outages depending on the timing, the duration, the particular services that are impacted. So we chose a very large range to be confident here of anywhere between 25 and 200 and almost 60,000 employees that were impacted. And this is, I think, relatively straightforward. This is, I think nothing surprising here from a traditional FAIR risk analysis. But what we did do is that we also looked at this from the viewpoint of the public and our customers. And I think this is where we looked a little bit differently. We determined that based on the makeup of this bank's book of business, that anywhere between 14 and 30% of the customers could be negatively impacted on an outage of this type of duration. And by looking at the different types of transactions, the different types of losses that have occurred anecdotally and through regulatory disclosures at other bank outages, we determined that there was a pretty wide range of harm to customers. We saw anywhere from about $500 of impact all the way up to $3.6 million, and that skews somewhat heavily to the left with a most likely value around $147,000 per impacted customer. And so this is, I think, one thing that's maybe a little bit unique is that we can start looking at this from a different viewpoint, but aggregating these scenarios together. The other piece of this, and to what Doug talked about, is that when these events occur, there are typically secondary losses that occur as well. The public relations, the customer service, the responding to regulators and notifications of the issues were required to customers. All of these things have a real cost, and we were able to pull data again from other banks that have had similar operational impacts from their press releases and their regulatory filings to determine that this could be almost negligible, of around $1,000, up to on the high end for a extended duration outage, of 18 or so million dollars. We also made the assumption here that when this company is operating in an on-premise environment, as they are today, running their own data centers, that most of the response that is happening here will be conducted by the bank's employees. And this, I think, is important to understand what that response looks like when an outage does occur. So we were able to come up with these forms of loss and these range-based estimates, again, using, I would call it our standard FAIR toolkit here. And what we then did is that we modeled this out and said, each time this loss event occurs, what are the possible outcomes from a loss perspective? And this should be a familiar graphic to most of the audience here. This is a histogram of the single loss event magnitude of this particular scenario. So this is the range of possible outcomes that we would expect to see at an outage, given the nature that we talked about at the asset that we're referring to today. And what we see is there's a lot of variability here, because as we would expect, there's a lot of uncertainty in these types of events, and both how they play out, time of day, time of month, particular systems impacted. But what we were able to do is to determine that, based on this distribution, what was most likely, the most probable outcome, is around $9.7 million. The average of all of these events, right? So by conducting a Monte Carlo simulation and trying 50,000 iterations of this particular outage, we found that the average is closer to $34.5 million. But we don't think that that is very likely to occur. If we look at this, there's kind of less than a 1% chance of that occurring. The reality is that, on range here, there is a lot of uncertainty, and that is of concern, when we think about risk as uncertainty. If I'm not very sure how much something is going to cost, that's something that could keep me up at night. So we looked at this, as a resilience problem, and if this is the decision facing the bank, and what can we do about this? We're uncomfortable with the level of risk that we have and the uncertainty around that. So a logical next step was talk about moving some of this infrastructure to a cloud provider. And this is something that we see with many of our clients today, and this is a decision that a lot of firms, both in the financial services industry and elsewhere, are facing, is moving this legacy infrastructure to the cloud to be more resilient. So the next step of this, if we go back to that comparative analysis process, is to understand what changes and what would be different. So we looked at moving some of the key infrastructure that supports the consumer banking processes to the cloud. And we took a view of this, again, going back to the data that we have available, our experience helping companies do this work to begin with. And what we found is that there's a couple of key changes that happen when that are different between a cloud provider, a cloud hosted application, and what we're calling the financial services industry standard approach, the traditional on-premise managed data center type piece. From an architecture perspective, we see a major shift from what the traditional approach of what we call aversion to failure, meaning kind of traditional disaster recovery processes, failover, redundancy, and these types of things, to when you look at this from a cloud perspective, one of the key pieces of proper cloud architecture is anticipating that there will be failure and building that in automated processes to recover when failures do occur. Additionally, we look at the security controls and the processes around that allow us to respond to these incidents in a quick way. And one of the key differences that we found is that in a cloud provider, much of this response is automated. The control piece doesn't require manual intervention, and that is able to reduce their time to detect, respond, and recover to these types of incidents. Likewise, from a change management perspective, we find that when you move from this kind of semi-automated or automation-assisted change management process with humans heavily involved in the work to an automated testing CI/CD pipeline where changes are tested, rolled out, and able to also be rolled back in a very quick way, we see that has a very measurable impact on the duration and the ability to recover from these types of incidents. Likewise, from a service delivery model, one of the key themes here is that when you start to bake in automation that's enabled by the cloud providers and the services that they offer, you're able to do things much more quickly and with much less people. And this is, I think, a key theme that comes across as we go through these analyses. So looking at this scenario and understanding what changes as we move these key applications at this hypothetical bank out of their data centers and into the cloud, we found a couple of key things. But the biggest the biggest response, or I would say the largest sensitivity of this analysis, was on the duration of the outage. And when we look at the same types of incidents, the same types of outages that would cause up to a day or 4 hours of impact in a traditional environment, those exact same incidents as played out in public, are significantly less impactful than that. What we see is that these go from mere minutes to 4 hours, based on real historical data from other financial institutions that have had these denial of service and service disruptions. And most likely, this is kind of down an hour or so, reducing that from 4 hours to almost just over 1 hour. Likewise, we didn't necessarily change the number of impacted employees here. We're using that same large range. We would expect the same number of people to be impacted this way or otherwise. However, we would expect their impact to be less substantial, meaning that they'd be more quickly able to recover from this, and that there would be potentially less impact to their day-to-day operations. Likewise, we really didn't see much of a change in the number of consumers that were impacted, based on the ranges that were determined. However, what we do see is that the impact here is significantly reduced on the high end, because once you start talking about going entire days without being able to process or clear transactions, the losses that accumulate and the impact to the customers and to public are significantly higher if we can close things in the same business day and still clear transactions. So that had a significant impact when we played that out on a per customer basis. And then finally, one of the other, I think, key assumptions here that from a cost perspective is that most of the scenarios that we modeled out, the primary response is really led by the cloud service provider, with support and involvement from the bank's employees rather than the other way around. So we took these changes, we understood the key factors and forms of loss that were impacted, and we reran these scenarios. We reran the same 50,000 iterations of this, and what we're able to do then is compare the results. So what you're looking at here is a histogram of those those single loss event magnitudes over 50,000 iterations. And what you see here is that the blue bars, or the blue histogram, is that traditional on-premise, which has a lot of uncertainty. It's a relatively flat and long-tailed loss. So there were non-negligible probabilities of extreme losses. Whereas when we looked at this from a cloud perspective, we see that much more peaked and narrow distribution on the low end of these losses. And what that means is that we're able to better recover, we're able to better understand what the backside losses on these scenarios look like, and we have a much higher confidence level in what the losses incurred could be. Because we're eliminating the amount of time that uncertainty has to play out for. So if we compare this, just on its surface, just looking at the data itself, we see that our most likely single loss event magnitude is dropped almost in half, from $9.7 million down to just over $4.5 million. And then that's that most likely, right? So that's the outcome that has the highest probability of occurring. We also look at the average, because that helps us understand the spread and what those extreme outliers look like. And if we see here, that extreme maximum, right, the 1 out of 50,000 loss event, is dropped significantly from $323 million down to $72 million, and that therefore has a measurable impact on the average, dropping that realistically $25 million on average. So this is, I think, an interesting way to look at this, but how do you actually make use out of this, and how do you tell this story to your stakeholders about what are we actually getting by moving these applications to the cloud? And this is great raw data, and I think many of us will probably be able to interpret this and understand this directly. But if you take this same approach and you put this into what's called a loss exceedance curve, which basically helps us understand the probability of losing a certain amount of money from this event or more. And what we do is we can plot these two things, and this is based on that same analysis, that same data, and we can choose a risk appetite. And so am I comfortable with a 20% chance of losing this amount of money? What you see here is that the gap between these two scenarios isn't always consistent. So depending on how much of a risk appetite I have, that's going to vary based on the level of certainty that I want to have. Am I comfortable knowing that there's a 90% chance of losing more than $10 million? Well, I think that's relatively straightforward. But understanding, and we chose 20% because that's a good, what we see traditionally as a conservative or a financial institution kind of comfort level. What's the 20th percentile, or what's the 20% odds on something? And what we see is that in this scenario, we go from a 20% chance of losing $46 million from one of these outages down to a 20% chance of losing $14 million, right? So we've essentially reduced the risk from these scenarios by almost 70%, based on this particular risk appetite and tolerance that we have for that. And this is something that, again, is measurable. We can talk about the return on investment from a project. We can understand are the projects that we have in mind going to have the desired outcome. But I think what's very interesting with this, and I'll turn this over to Bill here just in a second to talk about this specifically from the banking perspective or the financial services firm perspective, is that this can have a real and measurable impact in cold hard dollars. So with that, I'll turn it over to Bill to talk a little bit about the way that bank capital charges work for operational risk.
Vince, if I could just interject one thing, just for people to keep in mind before Bill starts. While we used an example of a cloud provider, this is applicable to any technology change that's going to enhance the ability of an organization to deliver services and recover. The cloud is just one example of technology that can do that. The other piece that's very important here is to remember that pre and post implementation of the technology, using the FAIR to see what sort of recovery ability a project has done, and recording that for internal audit and regulatory purposes, which Bill will get into in a second, is important. But remember, cloud is just one example. This applies to anything that will benefit the recovery of the organization. Apologize for interrupting, but I just wanted to stress that it's to the operational risk component.
Yep. Good. So Bill, I'll turn the floor over to you here.
Okay, thank you, Vince. So on the next few slides, I'll cover ways that financial institutions measure operational risk for capital purposes, and also how capital charges can be impacted, just using an example that we've been going through, which is moving from on-premise to cloud computing. So just by way of overview, banks hold capital to absorb losses arising from their risk exposures, and that includes operational risk. So banks are required to hold capital for operational risk under two methods currently. One is under regulatory capital rules in place, and the second is through stress testing under the Comprehensive Capital Analysis and Review, or CCAR stress tests that are run by the Fed. So the regulatory capital requirements are pretty rules-based. It's derived from risk-weighted assets and operational risk included for what we call advanced approaches banks, and these are essentially the US GSIBs, the systemically important banks. And in addition, operational risk loss projections arise from the stress tests that occur under CCAR and get baked into the required stress capital buffers that banks should carry. These are based on results from the severe economic downturn scenarios that are part of the CCAR exercise. And this applies even more broadly than the strict regulatory capital rules. This applies to all the banks participating in CCAR in 2020. There were 33 banks that had over 100 billion of total assets. So large U.S. banks hold substantial capital resources for operational risk, several $100 billion of common equity, which includes those regulatory capital minimums and then add-ons for the stress loss estimates. However, regulators and banks have experienced challenges in modeling operational risk, particularly for the low frequency, high severity events. And as a result, regulators have ended up relying primarily on the industry's historical operational loss experience in setting operational risk capital requirements. And banks also have been challenged to translate reductions in their operational risk into reduced capital charges on a timely basis. So as in any risk area, we'd expect that reductions in risk are expected to result in reductions in capital charges, provided they're supported by sound risk measurement approaches. So here's where robust analytical techniques like we discussed under the FAIR method can be incorporated in stress test scenarios today, and even under potential changes in U.S. capital regime going forward. So if we look at the measures of risk reduction that are shown related to moving to the cloud, just running through the components. So the mechanisms by which risk is mitigated includes reduced model risk, cyber risk, resilience, recovery. So model risk in particular, we're talking about quality and accessibility of data that's used for modeling. Cyber risk of the direct loss estimates related to that particular threat. And recovery has to do with lower overall losses under stress. Impacting metrics like the CCAR stress testing results, internal economic capital estimates, the model risk roll-ups, and the cyber risk measurements. In turn, CCAR exercise in particular features stress losses related to operational risk, and those can be impacted by the analytics embedded in the scenario analysis, and also credit risk stress losses can be improved because of better portfolio segmentation, loss forecasting, and improved credit decision making related to improved data and analytics. And finally, the overall capital estimation comes into play with regard to, as we mentioned, risk-weighted assets, reg capital purposes, stress loss reductions, and overall RWA across the different risk areas, including operational risk and credit risk. So we go to the next slide. This just gives a sample of estimated values to show potential reductions in capital requirements related to cyber risk. If you look on the right-hand side, the risk-weighted assets for capital, those are the minimum requirements. And in this example, based on the current capital regimes and in the example we're using, credit risk typically is a significant portion of overall risk-weighted assets for capital. Market risk here is a slice at 10%, and we're using operational risk at 10%. And in this example, a cyber risk event is assumed to account for about 40% of operational risk using FAIR method and analytical techniques related to loss expectations from moving to the cloud. We have a 50% risk reduction in the cyber risk category, and that translates into an overall 2% risk-weighted asset reduction. It seems like a small number, but translating that into a 25 basis point reduction in a required capital ratio can be a very significant number for sizable banks, such as the example we're using here. And if you look on the left side for the CCAR loss estimates, in this case, the distribution of loss estimates is a little different than RWA, and that has partly to do with the scenario design and the types of idiosyncratic risks that are brought in to the scenario. So operational risk here is a 30% piece of total risk losses. We have cyber risk again at about 40% of that total. If we get a 50% reduction through these activities moving to the cloud, it reduces potentially overall losses by 6%. Again, it can be a very significant number for large banks in a CCAR scenario. If you put the two together, which would be the minimum requirements, and then these add-ons for CCAR loss estimates, the capital savings potentially could be in the $600 million range for a $250 billion bank. And if we just go to the next slide, this is just to highlight that it's not just the particular capital measurements that can be useful for financial institutions, but a similar approach can be applied to stress testing at the project level and even incorporated in BAU risk management processes. So as noted here, most banking organizations are challenged to actually measure a technology's project's reduction of resilience risk. And if a fair method can be used to stress test technology projects, we can see benefits at both the planning stage and after completion in terms of the items noted, the selection of projects, the measurement of the outcome, and the return on investments. All of this helping the board better understand trends in organizations' resilience risk, and the measures can be related to time, dollars, and as we just discussed, potential capital savings. So that brings us to the end of the presentation we have put together, but we'd be glad to answer any questions.
Yep.
Awesome. Well, thank you, gentlemen, for the presentation today. That's fantastic. We have a couple of questions in the Q&A module here that I can get started with. And if anybody else has any other questions that you want to type them in while we're doing these, I am happy to answer them and go through the line here for as long as we can. So first question here, guys, is how does operational resilience compare into operational risk? Is it a subdomain of op risk? And this was asked at the beginning of the webinar, so it may have been answered throughout a little bit, but just wanted to clarify for this.
Sure. Sure, this is Doug. So risk, we can think about the odds of an event occurring, number of attacks times the success of the attack at a very simple level. Resilience is, we need to crystallize that we're going to go down. An event will occur that will take us down. So the risk is looking at, sorry, there's a little feedback here. The risk is the left side of the fair, the resilience is the right, or the odds of an event occurring, but resilience is an event occurred, we're down, how do we come back up? And resilience per regulatory guidance, they want, the regulators, especially the BOE, PRA, and FCA, want you to crystallize that things will break so that events will occur. So we don't want to contemplate the odds of an event occurring or the likelihood. We just want to understand how we recover, knowing that events over time will happen.
Great, thank you, Doug. Next question here, resilience via architecture could result in some inefficiencies. How is that communicated and handled?
So I'll start at a high level, and I'll drop it over to Vince for the fair part of this. If you're moving to a new piece of software, can it create inefficiencies? I guess it might. Part of the I guess tangential outcome here is to say, if you're implementing new technologies, the FAIR model can help you understand exactly what it's going to do to the resilience. With regards to inefficiencies in the processes organizationally, I don't know that we've contemplated that in the FAIR model, and I'll let Vince discuss that. But in terms of the ability to recover, and therefore the reduction in the operational risk, the FAIR model does a very good job of giving it a before and after. So even prior to implementing technology, you can get an understanding of exactly what the outcomes may look like due to that implementation. Vince, any ends there?
No, that's exactly right. And I think, when we look at this conceptually, this is a complex domain. there's obviously costs and benefits to any kind of architectural type change. What this allows you to do, though, is to help you actually quantify what the change is from a recoverability or a resilience perspective. This is one input to a complex decision that needs to be made. The goal here is to help you make that decision in an informed way, so that rather than just say, well, yeah, obviously we can recover faster if we have our application in the cloud, but is that worth it compared to, I don't know, some of the inefficiencies that may be created, or the cost of actually making that change or re-architecting the application in the first place. So the goal here is, again, to help the decision maker make that decision in an informed way by using models that are defensible and transparent and that can be done consistently.
All right, thank you both. I'm sorry, does somebody else want to add something? Okay. Moving on here, some of the graphs that you showed with different numbers on it, this is just kind of during the session question, but were the numbers in the graphs that you showed annualized? Is that how you measured them?
No, it's a great question. So that is the, what we call the single loss event magnitude. So think of that as the, when you talk about the kind of annualized loss exposure, or the kind of the results that you see, I'll call it out of the box with a fair analysis, you're factoring in the likelihood or the frequency at which those events occur. The reality of that is that most of these events are, what we call these extreme but plausible, or in the fair language, right, these are unstable risks, that your annual loss exposure is actually pretty low from these because they just don't happen very often. But from a regulatory perspective and from a resilience perspective, we want to know when this happens, or I guess if this happens, what are my losses going to look like, and how long can I sustain those losses before there's a material impact to my ability to stay solvent. And so the numbers and the graphs and all the analysis that we were looking at is the single loss event magnitude. You can think about this, if you're kind of a fair practitioner, this is the equivalent of setting loss event frequency to 1.0, right? It's the same idea, but we just modeled the right side of the fair model.
All right, thank you, Vince. Next question here. Can you please explain how you calculated the per customer losses? Are these institutional clients or customers like you and I?
It's a range of both. So I can go back to here in just a second, but if you look, these were like kind of a couple $100 up to millions of dollars of impact. And the way that this was actually calculated was by looking at public outages and events that have occurred, and the claims that have been filed against those outages to the banks, where they sought certain damages directly. So we had a pretty big range, and if you look at the makeup of our hypothetical bank, we said, it's 14 to 30% of the revenue from this bank came from those, let's call them retail and commercial banking services. And that takes out some of the other things, wealth management, that takes out some of the treasury management, some of those are bigger things. But our asset was specifically focused on the consumer banking services, which includes kind of businesses and you and I type people.
Awesome, thank you, Vince.
Yep.
Next question here. I'm new to FAIR still, but would you say that you use it to do the following? Analyze the risk for a system. If you want to reduce that risk, model a strategy, new firewall, etc., to see how much you would reduce risk. If you proceed with the project and measure your actual reduction, to measure your assessment and the project's success.
Yes, so to that, there's a couple of ways to use risk analysis, right? And this is the way we look at it at Protiviti. you can use FAIR or any risk quantification method, if you will, to look at kind of the past, present, or the future. If we look at the past, to your point, understanding, and we'll talk about maybe monitoring accuracy here in a minute, but we can look at things that have happened in the past and understand what those looked like. That's relatively straightforward to do, and you don't need a lot of probabilistic modeling to do that. We can use risk analysis in the present to do oversight, to understand what are our top risks, what are the things that could happen if they occur, are we meeting our obligations and our compliance, right? But then kind of the use case that we just walked through here is foresight, or using risk analysis to look at the future, where we say, what if I make a change? What could be the potential reduction in loss exposure, right? Look at that from a return on investment perspective, or a return on control perspective. And these, I think, are really useful ways to look at this. FAIR in and of itself is just a model. It's just a way to consistently and repeatably measure loss exposure, right? It fits into a broader risk management program, so that when you're doing these activities, you can do them consistently in a defensible way. The goal of any FAIR analysis is to ultimately help you make a decision. So if we think about the decisions that we're trying to make, this is just one way to get some data to make that decision in an informed way. But to your point, I think that the outline that you said is very good. And I think the second part of that was also very interesting. Is so how do you know if you did a good job on any risk analysis? And that's a challenging thing to do. There are some mechanisms in place. There are some ways to monitor, actual losses when they occur. The reality is, and I think that's one of the struggles that a lot of our clients have, is how do you show that this was actually worth it? And that's why we kind of propose this approach with the capital requirements. Is there's a tangible outcome that you can take to get an immediate return on kind of your effort here. And I think that that's something that's very useful to do. If you are curious about how do you monitor the performance of risk models and things like that, there's a whole kind of field of study on that. There's some things that have been published around things called Briar scores and the like to do that, but that's maybe a chapter for another webinar.
Well, it sounds like we have our next topic maybe. But we have time for one more question here, and I'm just going to read it direct here. So the person's saying, I do not understand using FAIR to quantify. I do understand using FAIR to quantify the cyber risk and therefore contribute in the capital charge from an op risk perspective, which will focus on reducing a loss should a risk crystallize. But whereas op resilience would consider a risk has crystallized, thus the focus is on the tolerance impact as mentioned in the first slides, i.e. sustain the business service while recovering. I don't then understand how FAIR can apply for op resilience.
So if you take the right side of the FAIR model, and if you can quantify the cost of downtime, what you're essentially doing is quantifying what the Bank of England called your impact tolerance, which is you'll be able to see how much it cost you to be down, right? And you'll be able to decompose those costs to a very detailed level. And then you'll be able to judge how long you can be down before you actually go out of business. So in that regard, you are essentially addressing the impact tolerance component, which is looking at that piece. In terms of the cyber versus non-cyber, the way we view it is an event occurs. What caused that event is not as important as the outcome of that event. So if I had a cyber attack, or if I had a system explode in one of my data centers, the outcome of those two is the same. I have some sort of challenging environment that I have to get through. So the way we use FAIR, and Vince can go into the details, is beyond just saying we're looking at a cyber attack, and now we're just saying, okay, something happened. How do we appropriately model the fact that something happened? Because downtime is in fact downtime. It doesn't matter what caused it. You're down, you're not producing widgets, or you're not, allowing people to withdraw from the ATM. To the customer and to the organization, whatever caused that issue is of less consequence than the fact that you're not being able to provide your goods and services. Vince, I don't know if you have anything to add there.
No, I think that's great. And I think that the piece of this is, how do you use FAIR to do this? Is it FAIR gives you a model to quantify and understand the loss exposure from events in a consistent, defensible, and transparent way, which is a key component of understanding your resilience risk. Good.
Fantastic. I think that was a great line to leave off on.
Okay.
Thanks so much. So thank you, Vince and Bill and Doug. We are at time today. I really appreciate this super thoughtful and very interesting presentation today. To everybody listening, thank you for attending. This session has been recorded and will be posted to link in a little bit as soon as it's done processing with a copy of the slides. And if you have any questions, feel free to reach out, start a discussion on link, or connect with one of the team from Protiviti. So thank you very much, and enjoy the rest of the day, and have a nice rest of the week and weekend. Thanks, everybody.